Good morning, traders and investors. We're back into the market. We got the 25 basis point rate hike. Now, of course, did the central bank give the intentions that they're nearing the end of the rate hiking cycle? Questions being asked. Will we get a pivot this year, right? Things to think about. And of course, we'll take a look at what's going on. Is the banking situation done? Is it not? We'll take a look at Ford announcing their electric vehicle business lost $2.1 billion. Coinbase with a Wells notice. We got Chewy, KB Homes getting some earnings. Sanofi and Regeneron shares getting a little bit of a boost. Darden Restaurant reporting today. A lot to get into. And of course, our guest today, Jonathan Corpina. You guys smash the like. It's time to rise and shine, traders. It's pre-market prep. Coming to you live from downtown Detroit, this is Benzinga's Pre-Market Prep with your hosts, Joel Elkanin.
This is a volatile puppy here, isn't it?
And Dennis Dick.
I'm bidding a penny. I'd buy that stock for a penny.
With everything you need to start your trading day.
All right, good morning, traders and investors. We're showing a little green here on the screen, up 15 and a half handles at 39.86. The buck, after a couple bad days, trying to have a good day, up just 4 cents, just over 102. Bonds up a quarter of a point, 131 and 7/30 seconds. Crude residing in the 70 handle, but down 46 cents at 70.44. Another good day for gold, up 31 bucks, 19.8060. Silver participating for a change, up 24 cents at 23.02. And Bitcoin bouncing back with being the tech stock it is. It's up $845 at 27,645. Triple D, I see a lot of green here, but I see a proportionate amount of green going to big tech once again.
Yeah.
They love the big tech.
Yeah, it's the safety trade. And again, they go to what that has been working here. You can see the clear rotation. I mean, just bring up the IWM, which is your small caps full of banks, full of smaller stocks that need capital if we get in tighter capital because of the banking crisis here. IWM sitting right near the lows of the whole year, down at 170. And then you have the Qs, a completely different story. Up from 260 to 308, up here again. So, I mean, the rotation here is nothing short of violent. Once again here this morning, it's big tech that's getting the money. You can see most stuff is green, but the major tech stocks are a lot more green than some of the other stocks that you see. So
yeah,
it's
Apple
again
up,
rotation.
You have the SPY up about 0.5%. Let's just go through this real quick.
Yeah.
Apple almost up 1%. Microsoft up over 1%.
Yeah.
Google hanging in there, 0.5%. Amazon 1.39. Nvidia, you can't stop Nvidia, 1.78%. And good old Tesla rebounding up 2%. And there you have, JP Morgan's getting a little bounce too, but clear rotation in the tech. And we also still earnings season. Mitch, does earnings season ever end?
Never.
It pretty much never ends, right? I mean, even when you think you're not getting the big boys, you get some of these smaller boys that start reporting. So, hey, it's how it is. But let's get to the action, of course. Let's start with just really quickly wrapping up what happened yesterday. Of course, we got the 25 basis point hike. Now the questions, of course, is the central bank nearing the end of its rate hiking cycle? I'll kick it to you guys. What do you think about that? At least the end of the rate hiking.
I'll throw it to you first there on that one.
Well, let's just talk about what exactly the Fed said yesterday here, Mitch, before we get into our specific commentary. So give us the rundown. Obviously, multiple comments. We had the Fed decision. They did go the quarter. We had some Yellen comments just right afterwards. We had the Powell press conference. We started very well with the market rip-roaring higher right off of the initial quarter. And a little bit of language change, but definitely not, signaling an imminent pause. What Well, give us a breakdown, Mitch.
All right. So one of the statements, of course, the main statement, the committee anticipates that some additional policy firming may be appropriate in order to attain a stance of monetary policy that's sufficiently restrictive to return inflation to 2% over time. He did say that the process of getting inflation back down to 2% has a long way to go and is likely to be bumpy. He said that despite market pricing into the contrary, rate cuts are not in our base case for the remainder of 2023. And of course, the US banking system is sound and resilient. Now, that one might come back to bite him. I don't know if he tried to give some certainty on that one, but we'll have to find out.
Yeah, they've got to say that. They're going to continue to say that. We could be in the full financial crisis, and they're going to say that because we know it's all about confidence here. Citigroup, interesting comments I read yesterday too. They said social media is a game changer for bank runs. And if you think back to the financial crisis in 2007, 2008, social media was very early, very new. A lot of people not even on social media at that time. Now word travels so fast, like, oh, FRC, people saying, well, your deposits might not be safe. That starts spreading through social media and everybody knows almost, it feels like instantly. So, I think I completely agree with that. Social media with the spreading of the word can really start people's fear and get it going. And that's all bank run really is. Like if you just go back and just look exactly what is a bank run, because maybe you don't know. A bank run is just simply depositors going into the bank and asking for their money back. Too many people, which is ask for the money at the same time, the bank doesn't have it because typically banks lend longer and they borrow, sometimes shorter with, just depositors on the books. So there's a mismatch in duration. So what happens is if too many people come into the bank and ask for their money all at once, the bank can't pay them. They don't have that much money. And that's what can get a bank run going. And then all of a sudden they're like, oh, our deposits aren't safe. And it snowballs from there. So it's all about confidence. As long as depositors stay with the bank's probably fine. Too many people start pulling their money out, then the bank can become insolvent very, very quickly because they don't have all of your money that you've lent the bank sitting there ready to give it back to you. It's too many people ask for the money all at once. That's where the bank gets into trouble.
And isn't it kind of asinine? Have you thought about, Dennis, like going to all the banks that you do business with and taking all your money out and put it under your mattress?
No, but I will tell you, I have thought about in here, Joel, is just I've looked at, where do I have? How much do I have? Do I have a whole pile of money just sitting there? How much is the insurance covered for? Spreading it out. I've always done GICs. I know they're only 100,000 each. So I've always laddered them. After the financial crisis, it was an eye-opener for me because we lost some banks and I got scared. So ever since then, I've always been cautious to spread it out. I bank at 3 different banking institutions. I spread out the money to a certain extent. So I don't have all my eggs in one basket, just in case. And we're not saying anything is imminent, but I think consumers may be becoming more prudent about that. And as they see, they're like, well, I want to spread it out a bit. I'm going to take some of my FRC money and put it over to JP Morgan, just maybe some of it, but that's enough, in some cases. So, we saw what the stock has done. It's definitely not, we don't know if, we're going to have an issue here, but when a stock goes from $120 to 14, the market is telling you there's a potential issue, and that's all. So I think it's about spreading it out. And if you've got your, deposit insurance, and a lot of the banks, it gets us $250. Canada, it's typically $100 in each individual account. The brokerages are different. The brokerages in Canada, I believe, are $1,099,000. I think in the US they're higher. I don't think they're $1 million though. I thought it was like 650, but again, I'm not in the US, so I haven't looked at that closely. So yeah, but it's about that insurance coverage. So. Joel, do you look at this? Like, we went through the financial crisis and it was really scary. Nothing like this. This is not the financial crisis. If you would have been there in 2007, 2008, you're seeing major banks, Lehman Brothers going to zero and Bear Stearns getting taken over for $2. You're like, is the world ending here? It was really scary. And how did they fix that? They just threw money at the problem. But you went through that, Joel. Did you kind of change how you invested or how you had your cash sitting after that? Because I sure did.
I think I kind of had it before that, like that. I never had like one major, concentration with,
spread it out.
Yep, the brokerages or or the banks or anything like that. So I think the main thing, I mean, the cash that I have in the bank, I certainly wouldn't want, if my cash at Bank America, one of the banks I go to, if that's gone, whew, I got a hell of a lot more to worry about than whatever cash I had in there.
And that's something
You
to
know,
think about too. But I just don't like having all my cash
Yep.
at one single bank. So just spreading it out is more prudent. Again, if you're like sitting with like $50,000 your life savings, you're probably fine. It's about that uninsured, get above those numbers. And me and Joel have been around a long time, so we've accumulated some wealth. We're not rich by any means, but we've accumulated some wealth over the years. Worked hard to accumulate this wealth. So you don't want to see just your bank fail and all of the wealth you accumulated potentially being locked up. Again, would you get the money? Some of these credit depositors going to get the money? Apparently they are. So even though their bank failed, apparently they're going to get the money. But do you want to go through the pain of all that being tied up? And do you want to, get into a situation maybe they don't cover it? And this brings us to Yellen's comments yesterday here, Joel, which Mitch, again, if you can find those Yellen comments.
already got them.
Mitch is awesome. But if you find those Yellen comments, this is probably what spooked the market even more, because they had Powell talking about, the banks being sound. And then they asked Yellen a specific question. What they talk about here?
So just a comment on Powell. Powell stated that all deposits would be backed up, and then the comments came a little bit later. Treasury Secretary Janet Yellen said that the U.S. is not working on a blanket insurance for bank deposits. So pretty much that all deposits would just be covered all around, right? If anything, what they did is they stepped in the banks that were in the concern, but they're just pretty much not saying that everything's covered out there. This is what also was being fought by Ackman, right? Ackman was saying that they needed to do this blanket insurance. So just kind of bringing in another investor that's saying that, yeah, I want to see that comment being mentioned, that they're backing up all deposits here. What do you think about this? I personally would say that, I don't know. I feel like the market's getting ahead of this. I feel like I know that the banking situation is a big concern, but if we get through this, are we just going to be feeling the FOMO? That's my only concern.
So take it back to the Yellen comment specifically, because Powell was saying one thing in one conference and Yellen was saying something else in another conference, and it was the mixed message that really spooked the market here. When Yellen said about, we're not looking at blanket insurance, like, well, Powell was just saying that you are. So you guys just totally contradicted each other. So one, either somebody's very misinformed or somebody's lying. So, I mean, the market got hammered when Yellen had said that. And maybe she just, said, maybe it wasn't what she meant to say. You're in live conferences. We do a live radio show or live podcast here. Sometimes what comes out of her mouth isn't exactly, it's not that we're lying. It's exactly like, how we want to say it. Because we're on the fly, we're winging everything. The words might not come out exactly how we want to say them. So until you've done, live podcasts and stuff, it's difficult to be perfect all the time. So maybe she was just, didn't say it perfectly, but it was pretty clear, her answer. So it didn't feel like that. It felt like they're maybe not going to look into insuring the uninsured deposits. And that spooked the market and that spooks, people in the banks. And the banks got hammered after that. FRC going down. It was $15.80 when this started. Ended up the day down at $13. Yes, it's bouncing here this morning. But it was really those Yellen comments that really pulled the rug out from the early rally.
Yeah, I think overall, Powell, I mean, what a tough job that guy has. I mean, whether you agree with what he's done or what he wasn't done, I kind of look at it. I'm just trying to put that, like, the market perspective on things, right? Like where we're at, what are the implications of this, right?
Yeah.
First of all, we're still up on the week. I mean, we closed last week.
We're up on the week.
Yeah, we're up on the week.
This is the impressive part, right? I mean, I know the banks are going down, but
39.47 was your close on Friday. Monday's close was a nice rally, 39.83. I don't like these ridiculous 100-point rallies, ahead of the Fed. It's Rob Friesen has, showed some good statistics of this. So I'd rather build a base. I'd rather, come down and build a base and put an area in where it's support. We just, like rallying 100. I mean, it was crazy to go down like we did and then back up what we did, and we get the comments. The onus is, on the bulls today to defend the low from yesterday. They did a heck of a job of it overnight. I mean, if you
Yeah.
sold into the kisser, yeah, you're on the close, you're underwater. You got the psychological 4,000 level now. I don't have any levels for you right there right now, except for the pre-market high of 4001.25. But I'm looking at yesterday's, or not yesterday, Tuesday's close. And man, we chopped through that thing so many times. So the market's still up on the week, right? That's a good thing. I mean, this 3,800, we all thought we were going, well, 3,850 basis the June contract. I mean, you just have to. I'm not revising my my call for the high for the year being in, but man, the Bulls got a chance to step up here today, and so far they're doing it. If we could just get through the next couple days, what if we could get to the next CPI number? I don't like to look too far ahead, but what if Powell's like really comfortable, like that CPI number is gonna go his way, and he'll be able to say, his next comments are, boom, things are looking okay. I mean, he could have come out and say, we're raising a quarter and we're done. And like Goldman coming out and saying, "Oh yeah, they're not going to hike."
That
He
was
didn't-
just a ridiculous.
Yeah, that was
call.
ridiculous
We called that
Who's
out
getting
and said
fired
there's
at
no chance of
Goldman?
that.
I
I don't know
they
what.
need
I don't
me.
know who put that out there, but that was a ridiculously bad call. We
Yeah,
called
I
that
mean,
out
come on,
yesterday
man.
morning on the show. They were going the quarter. We knew
They
they
had
were
to.
going the quarter.
I mean, the other banks were doing 50. What?
Oh, I know.
Were we going to go to zero? Like,
I
come
know.
on,
Yeah,
man.
they
Like,
weren't. Yeah. The inflation fight, and they were somewhat hawkish still in the commentary. I know some of the wording changed, but they basically said we're not giving up the fight on inflation. But they noted about the situation. They were noting about the situation in the bank and the banks, obviously. So I mean, if that worsens, they will go. If it worsens,
They will.
But right now it hasn't worsened. We've only lost a couple of decent sized banks here. Credit Suisse obviously is a different story in Europe, but nothing really too crazy yet. So they're sticking obviously until they get more information. Us as traders, we're obviously, waiting, and we're getting more information as well. But you can see the safety trade here. People are comfortable with tech. Tech is the new safety trade here, because if we go into a situation where credit gets tighter, Microsoft, Apple, Google, Meta are not going to have problems in their businesses because they have very little debt. Yes, Apple has some debt, but we know it could
pay it off in a heartbeat. Yeah.
Amazon, same story. So that's why big tech is doing better, because what you're seeing is a different story in the IWM. We can say how well the S&P is holding up, how good the SPY is doing. But when you look at the IWM, you can see a completely different story. IWM full of smaller companies. It's the Russell 2000. Some of these companies more dependent on credit. So if credit gets tighter, some of those other companies could struggle a bit. If we lose more banks, credit is going to get tighter. So you can clearly see the separation happening here, where you've got the IWM, which has been trading with a PE a hell of a lot lower than the S&P for a long time, trading much differently than the Qs, completely opposite charts to the Qs, where we've been talking about this inverse correlation between the IW and the Qs, which is nothing short of incredible, because I haven't seen that in a long, long time. And then the SPY has kind of a mix, so it's kind of in the middle. But on any given day, it seems like the IWM ripping, QQQ is not keeping up. And if the IWM is dipping, QQQ is doing well. So there's definitely, from the last week or two, an inverse correlation, a loose inverse correlation between the Qs and the IWM.
And also, I mean, if you want to, paint a bullish picture on things, which, you got to look at both sides of the market. I mean, how did we say, man, Apple has been holding up so well, the top component in the S&P,
Yes.
Microsoft. I mean, does that look, I mean, it's either the greatest selling opportunity of the world, or this thing really wants to take back 50% of its move. Google has not even had a meaningful retracement of its move, right? The big crank down. Also, Amazon. I mean, that hasn't had a meaningful move. Nvidia's the one that's perked up, right?
Oh my gosh, Nvidia.
Is that unbelievable? Yeah. And right there, you're looking at the 1, 2, 3, 4, 5 top components. Then the next component of the index is Tesla. And Tesla's made a nice move. And I would struggling at 200 a little bit, but I mean, that's still looking like you made a major low here at the beginning of 2023. So being S&P centric, looking at the cues and stuff, it's, it's hard. Everyone's like, today's the day, we're going down. When I look at my screen right now, it's hard for me to look at getting, short the S&Ps when these stocks are staring me in the face and they're going up. Of course, liquidity comes in at 9:30. Everything can change and you get a different, feel for the market. But man, oh
Someone
man, oh man, it was by the dip yesterday.
Someone made a comment on Twitter yesterday that it's not for the person, but the comment I thought was really a good one. Is this the market of 5 stocks? Because it seems like it is right now. 5 stocks pretty much keeping us up, riding us higher. That's the market breadth. And as long as, the big boys can stay strong, but if the big boys flip, that's where we got to be really
careful.
It's been the market of 5. The S&P has been the market of 5 stocks for the better part of the last decade. This is why, and Joel gets mad when I say it, I have said this before, the S&P is actually a poor indicator of the overall market here now because it's too heavy weighted into those major tech companies. There's a completely different story, which is what we just had this conversation about. Completely different story in a broad index like the IWM. You can see a completely different story. Obviously, QQQs follow those same stocks. SPY is almost like a mini tech index, though, now because it's just too heavy weighted those. We know with the oil, even with the great year that oil had, how much is oil in the S&P? It's not like it's 20%. It's like 4 or 5% in the last time I looked, even after a great run. So, in the banks, we know never caught up. And again, investing in banks, and I stopped investing in the banks, except for the Canadian ones. I do have a couple Canadian ones, but I stopped investing in the U.S. banks back during the financial crisis. I had Citigroup in my long-term portfolio. I'd bought in like 2002, and I watched the stock go from back then $50 to $5, and they did the reverse split. And you can look and say, well, why didn't you hold on? It came back. Again, I'm going to repeat this. It never came back, folks. It did a 1-for-10 reverse split. Citigroup is in the same bloody spot it was 15 years ago. Yes, you got a dividend. That was awesome. You got your 3-4%. But for a long time, they didn't even pay a dividend. So it's JP Morgan came back, and JP Morgan made new highs. But a lot of these banks never came back. They have been crappy investments for a long time. There was a chart floating around. Bring this up, XLF, Joel, just to give you a feel. And XLF is helped substantially because of Berkshire Hathaway. And Berkshire Hathaway has half Apple. So XLF actually has some Apple in it, if you just figure it out that way. But bring up the long-term chart of XLF. Go way back. I don't know if in the bottom right, if you can go further back than that. But we have gotten to a point, you're only going to 2014. Well, if you go back to 2007, 2008, there you go. You will see in the last 15 years, if you invested in XLF 15 years ago, you are in the same spot. It has been a really crappy investment to invest in the banks. Yes, you got paid some dividends, 2.7, 2.5%, but the market has blasted off without you. And again, this XLF chart is being helped by Apple because I believe the XLF is 12% Berk and Berk is half Apple. So basically it's 5 or 6% Apple. So the XLF and the banks have been very crappy investments for a long time. And now you're going into potentially another financial crisis. Makes me not want to invest in a bank ever again. They're crappy investments.
Yeah, definitely. And it's something to watch for. You got to be looking for what they're going to be coming after now. Will they still come after these financial names? That's what I'm looking at. I've been focusing on like the bigger names. I did see Bank of America crack through that low. I don't know if
Mitch,
you guys
are you
saw
talking
that.
about like what do you like? What are you talking about your long-term portfolio? Because we talk a lot about our long-term portfolios and stuff we do. Are you talking about stuff that you're stashing away for the next 5, 10, 15 years?
That's a good question here. Just are you looking, Mitch, to do some long-term investing in some companies at these prices? Because a lot of people are stashing. This is my point. A lot of people are stashing away banks right now, saying, well, these things are coming back. And I'm just saying, if you stashed away banks in 2007, 2008, for the most part, you never got your money back. And you've been underperforming the market for a long time. And I think that's why this rotation to tech is so violent, because the market has been here before. We have seen the crap that financial crises do. We have seen that there is risk here. And we saw coming out of the financial crisis in 2008 and 2009 that tech was a winner for a very long time. So the market is going back to what it is comfortable with. And it's not comfortable with banks. Burn me once, shame on you. Burn me twice, shame on me. That's what the market is saying here, I believe, in the XLF. And yes, we might bounce. And yes, maybe these banks are going to go back to the highs. But they've underperformed the market for a very long time. So, Mitch, just bringing it back to you. Would you be jumping in and buying and investing in banks at this point in time?
I think right now, the way that I'm looking at it is that I want to see what happens first with the smaller banks to see if we get some consolidation to the bigger banks. If there's any one that I would probably be buying, of course, lovely Kramer's Fortress, right? Probably JPM, but that's just
JP Morgan.
Yeah, that's
Maybe.
just because what I kind of believe won't disappear, right? For right now, if I'm dipping my toes, it's on companies I think that won't disappear in the next kind of weeks or two, right? But am I jumping into these smaller names? Am I jumping into a PACW, a Wall? Am I jumping into these smaller ones? No, I just feel like even the return, yes, it could be massive. But is that a risk that I want to take with my hard-earned money right now? I feel like there's other places to put my money. And that's why I've been looking at, the energy and the tech names, not to get into those trades, but just I'd rather trade that right now than to be jumping into these long-term and then just get crushed. Because when we get crushed, the biggest thing I think right now that's important is keeping my mental capital for when we can get through this situation. I'm not just destroyed mentally and can get ready to get back into the market.
But Mitch, you're so young. You got to be thinking about 15, 20, 30 years on the line. You can't be waiting to see if we get through this financial crisis or not, because could be another crisis by then. I mean,
exactly. But the banks is not where I'm looking to make a generational wealth.
And you know what? You're correct. You're correct here, Mitch, because what you are thinking, what you just spoke, is exactly what the market is thinking. Why do I want to bother with these banks when they've underperformed for 15 years and there's all this risk here? Why not go back to what has worked? And that is why the market is gravitating to tech. And this may continue. Even if we go into a banking crisis, I'll tell you, if we go into a banking crisis, tech probably outperforms. Now, tech could go down too. Don't kid yourself. It gets ugly. It could all go down together. But I think tech goes down less than those banks if we go into a banking crisis. It's pretty much guaranteed. If we go into a banking crisis, the bank's going to go down a hell of a lot more. If we bounce back, maybe the Pac West, and some of these like 10s can come back to the 25s. But I bought PACW on like day 2 or day 3 because I didn't think the contagion was going to be there. These things have just stayed down here for too long now. They've been down here for too long. It's like, I thought it was overdone because we lost one bank and they're like, oh, they're going to hit all these regionals and this is just getting overdone. But then you start looking, here we are 2 weeks later and these things are not bouncing back. And that is getting more fear into this market, from the depositor standpoints. There's people talking about it. I had a friend reaching out and he has money at, I forget which one it was, at Schwab. He's got a whole pile of money, all of their money. All of their wealth is at Schwab, 100% of it. No other bank, no other, just in the brokerage at Schwab and talking millions of dollars. And they're like, is my money safe? And I'm like, well, I'm not a banker. I'm not with Schwab. I can't comment on that. But why not diversify a little bit? That's what I just said. Why not, take a little bit and put it a little bit over at Morgan or put a little bit over at Goldman or why not move it around?
We're about to get numbers here dropping in. Just want to catch you guys before you get hit, Dennis. Just want to call that out there. Jobless numbers going to come in right now.
Okay here.
So just pay attention to that. Jobless numbers will be coming in. They haven't been really moving the markets too much, but let's just pay attention as it comes in here. Just give it a second and I should get the number in a second. So how's the price action at least on the spot?
It's quiet. Yeah, we haven't we had a nice rally overnight, as I mentioned, and we're just kind of like it's indecision here, just kind of hanging out mid-range, nothing wild here. People that bought the dip yesterday, they're like, I'm not waiting for the regular session, I'm peeling out of it. And you don't have super aggressive buyers yet to think we're going right back up. I will say though, I'm looking at this Schwab chart and man, $60. I don't know what your position is, but there's no daylight. And this, there's a wall at 60. Someone's just saying, I'm out. Maybe they bought that dip on the day that, how low did this thing get? It had that spike low to 45 and just been buying it and supporting it. So if I was a Schwab shareholder, if I had a dime over there, the longer it takes to clear 60, the more I'd be worried about one. That's some major resistance here. It doesn't look like we're moving. I mean, after a day like yesterday, you're going to need some pretty big, news to move the markets. But still
Well,
up 18 handles.
one thing I just want to state, I know the chat was trying to hit me there because I'm not thinking long term, but what long term are we going to receive from this, right? And what's the risk? This is my biggest thing. I'm always looking for risk and return.
Yeah.
This it's not there, team. It's high risk, high reward.
So do you got a lot of T-bills? Do you got a lot
It's not
of
even.
CDs?
So sorry, I was going to say it's not even high reward because the XLF's gone nowhere for 15 bloody years.
So then high risk, low reward?
Here you were investing. Bring up Citigroup's chart. Bring up
You
Citigroup.
love
Case
the
in point here.
Citigroup
We always
chart.
go back to Citigroup, and we
This
can
is
show
where it gets
JP Morgan it's a little bit of a different
confusing,
story. Here's your Citigroup chart. And you went in there in 2009 after the financial crisis, and you're like, you know what? Citigroup, this is it. It's down 90% from the highs. I'm going to invest and put all my money in Citigroup because this is eventually coming back.
This is chasing
Here you are. Here you are. You took all the risk because Citigroup could have easily went under then. We lost Lehman. Bear Stearns got taken over. WAMU. We had a mess then. You took all that risk, and here is your reward. The stock is still in the same place. Stock is still in the same place. Now go to do Wells Fargo, do WFC. WFC has come back a long ways, but even adding up percentages, there's no way kept up with the NASDAQ. So here you're, hardly came back at all too. 09, 36, yeah, we went down to $9. We're $37. 15 years later, your hard-earned money in Wells Fargo's collecting a little 2-3% dividend. Thank you very much, but I can get 4% right now in the 2-year. So why come in here and take the risk? And this is why the people are not. This is why the banks aren't bouncing to a certain extent. Wells Fargo made a new low on the year yesterday. Go to JC Peretz. Obviously, we talk about him a lot, but JC Peretz usually isn't buying stocks making new lows, or Mark Chaikin isn't buying stocks making new lows. And again, if you're looking at buying stocks making new lows, sometimes they do reverse, but the history here isn't on the side. There's Bank America. Bank America never came back, folks. Never got all the way back. Now, JP Morgan did. Again, Jamie Dimon learning before the financial crisis and genius as he is, JP Morgan has gone up a lot and done really well. So 07, 60 to 120. But even that, 15 years and the stock has doubled. Well, that's not great. It's good. Bring up Apple in the same time frame. And this is why they're going to major tech. Oh my gosh, Apple from $10 to $157 is up 1,500%. So you can see the clear rotation what has happened in the last 12 years. People are calling for a catch-up trade in the banks, but the risk is just so high and the return is just not that great.
Mm-hmm.
Square is getting crushed here right now. What is going on with Square? I'm going to call it Square forever, but we are getting absolutely hammered on Square right now. It is down 13%.
Ooh.
Something just happened.
I'm looking. I see lawsuits, but I don't think that could be it. There has to be something else coming in here.
Off the low. Made a low at 61.30. Oh boy, this is back in this area here. It's giving back all the gains.
Oh, the old Hindenburg short
report. It went down this much on Hindenburg? Hindenburg research. Our research indicates that Block has wildly overstated genuine user counts and understated its customer acquisition costs. Hindenburg out with a short report here. I cannot believe this stock is down 12% on Hindenburg. This is an overshoot in my opinion. Again, this is just breaking here, but I feel like this is a major overshoot here. I don't like buying the dip, but holy mackerel, at 60 is huge there.
Yeah,
this feels like an overshoot.
Wow.
I'm looking up
this feels like a
I'm trying to get to their website right now.
Hindenburg can do some good research. They're not always some of these companies do really good research, but wow, this isn't, company news here. This is down 13% on Hindenburg report. I'm very surprised down this much.
What a good atmosphere to drop it in too, pre-market, making people
63.50 right now.
Yeah.
I'll just make a call. I think it's going to end up being higher here today, higher than this, 63.50. I didn't buy it here because we're talking about it, but I feel like this is going to bounce back. But again, just a call. Maybe it's, I haven't read the report. I haven't read anything on it. I just saw the headline.
Here's that report here, team.
Trading up the headline. But I feel like this is an overshoot.
Here's the link if you guys want to check out that report.
How inflated user metrics and frictionless fraud. Man, they must get sued really big time.
Frictionless
with this
fraud.
stuff, eh? They must have a whole legal team. Because these are big
Yeah.
allegations these companies make, man.
Yeah, the magical financial technology with a mission to empower the unbanked and the underbanked. There's a lot of comments on here, even Dorsey comments. The only thing I don't like is when I read these and they get a little too personal. Like they just go after like the CEO about like character. But other than that, I read these all the time. So check it out, team. I threw up the link if you guys want to go into it. Hindenburg has
High
it up
risk
already.
right now, though.
So
we will
yeah,
say, like, when
definitely high
stocks are
risk.
moving like this, they're high risk. So I was like 63.50. I paper trading buying it at 63.50. Complete paper trade. I don't have it on. So just my opinion.
The other thing too is that the company,
and I'm already down $1, so I'm not doing very good on this paper trade.
the good thing it's a paper trade. I was looking at this whole 58 to 60 area, under $60. We had multiple lows. We'll see if the bulls step up in that area. Also, with these kind of things, with if you're shorting it in a hole, you believe Hindenburg is the smartest in the world, and this is going out of business. The company will come out. They should come out and say something. They will come out and refute this. Right now, their lawyers are working feverishly. But yeah, that right now the bulls got it. I'm looking at this 58 to 60.
There's people selling. There's a 69,000 share offer at 62. So holy mackerel, I'm down on that paper trade.
Yeah,
wow.
You're down.
There is major risk when the things are falling and moving like this. It's all risk. It's a hell of a lot of risk. But holy, I can't believe it's down 16% on Hindenburg report. Again, to Spinner's point is they've come out with some pretty good research before. So whether there's any,
did you get on the PayPal, Dennis? It's just stock specific here. The PayPal. I mean, this is very stock specific. Got a
relationship.
Yeah, well, there is. Like I do pair trade Square with PayPal. It wouldn't surprise me if PayPal sees some pressure here because Square, that's just down huge. So
yeah,
you could see a little bit of pressure. It's down 17%. Wow.
All right, let's go
I don't even
ahead.
know what to say.
Let's get to our guest today. Let's keep it rolling right here.
Bad paper
Market
trade.
Prep. All right, Jonathan Corpina, Senior Managing Partner at Meridian Equity Partners. How we doing, Jonathan? It's good to have you back on. Oh, looks like we might have got him when he's busy right quick. He'll be right with us here. Just give me 1 second here. You're muted right quick, Jonathan. He might be.
There we go.
Oh, there you go. We got you. How we doing today, Jonathan?
Good morning. Thank you for having me on.
I got the schedule now down with Jonathan.
Yeah, we got it.
We got it. It took some time back and forth, but he works at home 1 day a week, right? Just about?
Yeah, 1 or 2 days a week I'm at home, and then the other days I'm down at the stock exchange.
Yeah, and so the connectivity, and you got sharp office with all that sports stuff, man.
Yeah, all good stuff. Were you a football
player? Were you a football? I know we asked this.
I was a hockey player, but I'm a big Giants.
Nice.
I'm a big Giants fan, so you can see some Giants footballs back there. I've got how do I do this? Wayne Gretzky's gloves over here.
Ooh, Dennis. Oh, Dennis. Now.
You get full screen. Remove us for that.
There you go.
Zoom in there. Zoom in there. Look at all this nice stuff.
Yeah,
all right, Jonathan.
Couple of good things there.
Before we could do the macro talk, we could do the sector talk, we could do the rotation talk. But we had a guest on yesterday, Dave Lauer, and I was talking to him about the limit up and the limit down in these bank stocks. And to me, they're just targets, man. I mean, the big boys pushing, they know they can push it to that area. Maybe they're short, they put a bid out at that area, or they wait for it to come out the hall. A lot of times you're seeing reversals on these things. I mean, you got orders on the deck. You had to have some orders for some of these things. I'm not asking for specific stocks, but how do you handle these halts?
Yeah, the halts, were put in place, and I think they serve their purpose, right? They do what they're supposed to do. The parameters that are outside the market, they update as the stock trades, right? So the limit up and the limit down, or the bands continue to shift, and they're there to pause trading when there is massive volatility, either to the upside or to the downside. Certainly, there are people who can track the bands and put bids and offers right inside those bands, because we do sometimes see that these stocks get close to them, right? And then the bands reset, and then they shift, and then they continue to shift again. So we do see sometimes that they get close to the bands and then back off. But I think with the activity that we've seen over the last what is it, 10 trading sessions, what's going on with the regional banks. Clearly they've been used, they've been tested, and I think they've served their purpose, right? Once you hit a band, it's a 5-minute halt. It gives everybody a time to kind of take a step back, take a breath, see what's going on, and then continue from there. Fortunately or unfortunately, the bands that we've seen this week only have slowed things down. They never really made the stock pivot, and I don't think they're there to pivot. They are there to slow things down. So if you look at some of these banks that we've been trading in, we hit a pause, 5 minutes, and then trades down again, hits another pause, 5 minutes, trades down again, and then we see it back on the other side. Conversely, First Republic, we saw it the other day, just kept hitting limit up, and it goes into the volatility trading pause. So it's there for a purpose. I think it's done what it's supposed to do, and it does somewhat kind of dampen the volatility. But when you have freight trains that are either pushing a stock up or down, it's hard to get in front of that.
So, obviously we're in this electronic world, right? And everything is going through the system and everything. But are is there big crowds around? Back in the day, and in the pit, some if things would be quiet, come in, and a big broker would come in, and people would claw over each other and try and get to the guy. Is that kind of that fun atmosphere back, or is it still just jamming everything through the pipes?
Yes, so it's kind of a combination, right? The order flow, all the order flow that we do, all the order flow that everybody does is all electronic, right? So the days of paper and writing thing down and handing pieces of paper back and forth, that's completely gone, and we're okay with that. We've become much more collectively efficient traders in this electronic world. But when we hit a limit up, limit down scenario with a VTP, a volatility trading pause, it does bring people back to the crowd, because we know for a fact that the stock will not open for 5 minutes. We know for a fact that order flow is still coming in, and the market maker is pricing that out. So we get information as to what is this stock going to look when it reopens. We know it's not going to open before 5 minutes. The reopening process is either automatic, where it pairs off and the market maker, the DMM, says, all right, we're letting it go, or it's a manual process where the DMM is there and they're entering their interest, and they're bringing in the other interest from the book and from the crowd, all electronic, and they're saying, okay, this is the price that we're going to open at. Is everybody good? Done. The stock opens. So it is a combination of electronic order flow and human interaction. The information that we get, I think, is key on these reopenings, and then just kind of take a step back. The reopening process is no different than our everyday opening process and our everyday closing process, right? So we do this all day, every day. It just seems like, to the outside world, this is a big event, but these VTPs, this is just a reopening process. We do this twice a day.
Jonathan, I've advocated here for some changes to the limit up, limit down system, because I've watched FRC, and we've seen this even during COVID, where you actually have fair and orderly trading in the pre-market. FRC is very calm right now, traded orderly, but because it'll hit these parameters at 9:30, the stock will immediately halt. I think in some cases where news or volatility is escalated, can we maybe talk about potentially doing some adjustments to these, where maybe if you hit one halt on news and the bands go wider, and then maybe if it's another halt, they go wider here again, because apparently this is just, it seems disruptive to me. I see how smooth FRC is trading right now in the pre-market. It's calm, it's orderly, and then all of a sudden it opens and it halts because it's hit some stupid parameter here, and then the trading, it scares people. It scares people. I even saw CNBC and obviously, in some cases, some of them, maybe the people on CNBC don't understand. They're like, oh, FRC is halted right now. Is there news? And they're checking news. It was like, it's been halted 5 times today. It's halted for the limit up, limit down. It spooks people to a certain extent. So where it's supposed to bring calm, and where it's supposed to, in some cases, when we know there's news on FRC continuously, there's stuff happening here. It's just being halted for volatility. Should there be some adjustments to these bands here?
Yeah, so a lot there. Let me kind of unravel it, Dennis, and I'll work backwards. So the media loves to say stocks are halted and cause that drama, and they put the banner on the screen, and then like they'll slide in, oh yeah, it's the fifth halt, and it's not news, it's volatility trading. So that's kind of one aspect to it. The second part that you touched on is I agree that these pauses, there should be some adjustments, right, that are associated with it, because when you have, and we see it both in New York and in NASDAQ, when you have pause after pause after pause after pause, it's like it disincentivizes people, right? They just kind of, then they'll pull their order flow out, and they'll just wait until it starts to get some flow to it, some not order flow, but just fluidity to it, right? So the stock doesn't pause, and then they'll come in. So there should be a way that the bands could be expanded, after multiple times are concerned. And then the last part, when you were talking about pre-market trading to open, keep in mind that some major funds that are out there globally are forced into executing on the primary market on the opening trade, right? So it's like they're watching some of this. They can only probably participate lightly, if at all, pre-market stuff. And then they're forced into being a block on that opening trade based off of prices where it's traded pre-market. And then that, in fact, causes a scenario where more volume comes in at a displaced price, and then you are going to get a pause. So, couple all of that together. I think this it serves its purpose. It does what it's supposed to do. But are there times when, especially market-wide, right, or sector-wide stuff, where there's an issue that maybe it should have some leeway to let it trade a little more? I think that's something that they could revisit. And keep in mind, all these rules and regulations, you guys have been in this business a long time. All these rules and regulations come in after things have happened, right? We look at trading scenarios, and they say, okay, how do we fix that? How do we prevent that? How do we make sure that scenario doesn't happen again, or it happens in a way where it's a little bit more organized? I do think that seeing what we're seeing now, in the regional banks, and how it's affecting the sector trading, I do think that they'll take a step back and look at how this all played out and see if there is any post-mortem adjustments they can make.
We're on the line with Jonathan Corpina. He's a senior vice president in Meridian Equity Partners. A floor guy. We know I have an affinity for floor people, but let's step away from the market structure talk. You've been in the markets quite a long time. You saw what happened during the financial crisis. You see what stresses, what things are going on in our economy. I mean, what do you? And I'm not going to ask you for specific banks here, but what the destruction that you're seeing, is it more of a, like Dennis has alluded to? This is like we're looking at Citigroups here, or we're definitely not looking at of JP Morgan's here. What's the general? I mean, they're all done. We don't need regional banks anymore. We're only going to have big mega cap banking and big banking centers. What's your take on this, and also in comparison to 2008?
Yeah, so I think I was watching your show, the lead on, when you were talking to Mitch about, what does he get in now and does he wait? And Mitch's reply, I think, is certainly in line with where I'm at. Like, we're gonna have to let this play out and see where this goes, right? So go back to last weekend, right? We've got Silicon Valley Bank, and then Signature gets pulled into it. And very quickly and efficiently, the government steps in and says, okay, depositors are fine. We're protecting 250 plus. Everything's good. And in the back of my head, I'm like, all right, good. You plugged a hole in the dam for now. But what happens when the next one rolls out? And can the government back every single deposit in every single bank that's out there? We're getting mixed messages that we heard yesterday. And I don't think that they can. I don't think that that's their plan. I don't think that that's a good business model for the government, just to have all these banks pop up all over the place, and they're now guaranteeing all the deposits that are there. So I think there's a lot that still has to unfold from here. I don't think there's a massive correlation between 2008 and what's going on now, right? That was a systemic issue with the overall financial and banking system. I think what this is just risk parameters and risky positions or portfolios that regional banks have. that larger banks can absorb. These are rounding errors for some of these larger banks, and some of these regional banks are getting into areas, and they're forced into getting to areas because they need to generate revenue and somehow to operate and maintain their operations. But they're getting into areas that maybe they shouldn't be, right? So do we see a consolidation in banks? I think the government's going to have to make it much harder for banks, for regional banks, for these small banks to operate in an efficient and effective way and be able to protect depositors. And there's got to be ways that they're going to have to be able to generate their revenue to run their operations in a way where it's not putting the depositors at risk. It's going to take a long time, unfortunately, for this to really play out, right? 2008, how many subcommittees did we watch out of the Senate and all these meetings, and then it turns into regulatory, and then it just kind of snowballs from there. This is going to be the same thing. How did this happen? Why did this happen? How can we prevent this from happening again? So do the regional banks roll up? I think some do, unfortunately. It's guilt by association. There's a group of banks out there, and we can, there's 4 or 5 of them that are fine and that everyone feels comfortable putting their money in. There's these other regional banks, and we call them regionals, but they're like real sizable banks that are out there. Look at Signature, like complete, got wrapped into this. We could discuss their crypto exposure, but Signature Bank is a bank that's been around for a long time and had a tremendous balance sheet. I personally, or not personally, my business banked with Signature Bank. It was so pro business for corporations, and we were forced into making an adjustment. This is going to be a lesson to everyone, and I think Dennis was saying it before about himself and people who are asking him. We're going to be forced into, for a period of time, having multiple banking relations and having money here and money there, and making sure that we kind of play this shell game of how much is protected here, how much is protected there, and all that's going to do is just generate fees for the banks.
All right, one more thing here. To move into tech here, Dennis, we'd like to look at, different, sector or different indexes. The Q's very, tech-led, and the S&P. So I said, if you're looking at the S&P chart, you're getting one feeling. If you're looking at the IWM, you get a little queasy feeling in your stomach here. Just comparing those two long-term projections. What's your take on those two? The implications of the directions of these two indexes.
Yeah, once again, listening to your guys' show this morning, that where's the money going, right? Where do people feel that they can put money into and find some returns that they're looking for? It's not in the financials. We've seen that rotation in and out of tech. That rotation seems like it's going back there again. And you guys mentioned this stock on your lead-in. Look at Apple. Apple's been just trying to get through 160. It can't. It gets there and then it pulls back again. And it just seems like that's either going 10 points higher or 10 points lower. But it feels like that rotation is moving into tech, but the charts on a sector level aren't really showing that. S&P 4,000, that psychological level.
There you go. Yep.
Is there resistance right above? Kind of feels like it. Is there support down below? Kind of gaps down there. If you take a step back and just look at the VIX and take out what's happened in the last 10 days, and I know you can't discount that, but just look at the VIX. It's been 25, they sell it, 20, they buy it. Back and forth and back and forth. And it seems like anytime S&P gets above 4,000, 4,100, they sell it, gets back down 3,700, they buy it. And unfortunately, we're going to continue to have this, right? And just kind of more on a macro level, we're so fixed on these regional banks and what's going on here and stuff like that. The headlines of Russia and China overnight, that's some scary stuff that we really should be focusing on, and what's going on there, and that allegiance that keeps getting stronger and stronger. That's something that's going to poke its head up in some point.
All right, Jonathan Corpina, Senior VP over at Meridian Equity Partners, joining us here on Pre-Market Prep. I like our schedule. We're going to get John more great information, Jonathan. Go Giants, too. Day. My buddy Ira likes the Giants. Triple D, the chop scenario.
Go back to Square. because this is crazy move.
I have something also. We'll take a look at the chart really quickly. I also have something to add. Of course,
add please.
Of course, who would be adding Square yesterday? Of course, Kathy Wood. She loves to add on the best days,
She
right?
actually sold coin, I guess, the day before, and Coinbase is your other loser of the day. So she actually sold a bunch of coins. So I guess give her credit where credit is due. She actually sold almost the top on some of that coin.
Maybe she got a little heads up from the SEC, but
we don't say stuff like that. That 100% did not do that.
No, I mean, at the end of the day, there was multiple reports out there.
That's how rumors start, though. We're gonna just strike that from the record. That definitely
delete
did
that
not
from the show.
That was a joke, but he was joking. But it was
People
will take that. The problem is when you joke on a live show, then people run with it. Oh, he said it. So we're striking that. That was a joke.
That's why I said could have.
Yeah, that was a joke. Exactly. But I'm just clarifying that Mitch's comment was a joke. But
the big thing here is
I want you to learn from a very bad paper trade here on me. 1, don't jump and try to catch a falling knife on breaking news. 2, when news breaks and stocks are getting hammered, go to your Joel Alconin levels of support. Because when the stock has nothing in there, and it had nothing in there at 63 when I was talking about it, now it's 58. You can see where it's trying to bottom here is actually at the December lows of 58.34. So when you have breaking news and the violent thing is getting thrown so hard, often wait until it actually hits the floor. The floor around there is 58.50, right around where it is right now. At least it gives you a chance. But I had no idea that Hindenburg would have this kind of power on block. That is unbelievable to me. So even though I don't, I can't believe that it's down this much on this, it doesn't mean that the market is going to hammer it farther. Because we know this is the market where, when there's something bad going on, they hit first and ask questions later. So absolutely terrible paper trade, if you want to call it a paper trade there at 63, instantly losing 10%. So, or 8%. So again, I just want, sometimes I make some good calls. It was a very bad call by me.
Yeah, 57.62 is actually at the actual low. And who knows how this is going to trade in the next 32 minutes. And I haven't heard anything from the company. So they gotta be working on that press release. But it just kind of feels like it might be one of these days where that pre-market low, wherever it happens to be. I don't know if it's going to be 57.62 when like the liquidity, comes in at 9:30, might be a real good level to keep an eye on. But right now, getting a bounce 57.62. If I had to do a paper trade right now, I'd buy it, lean on that low. That's only $1. We'll see if that 57.62 holds up. You know what? This is an unprecedented show here because we did not do KBH earnings. We did not do.
Do they matter? Do they matter?
Boring.
No, throw that out the window.
Who
cares about KBH?
What about Coinbase?
Who's trading KBH today?
Well, we mentioned
in the chat. Who's trading KBH?
Coinbase. Mention it again. Bring up Coinbase. So let's go into the Coinbase news because we didn't cover it. We did mention it, but we didn't cover it. Give us Coinbase.
All right, let's get to Coinbase Global. Shares are trading lower after the company received a Wells notice from the SEC alleging violations federal security laws in regard to the company's spot market and staking service. What does that entitle? I mean, you guys got to look a little deeper. We'll find out, I'm sure, in the next couple of days. But if I was a Coinbase investor, would this scare me? It definitely would.
And okay, so Wells notice, just to clarify, this is a notice that is typically given to a firm prior to litigation. So basically letting you know that we intend to put an enforcement action on your firm, but we haven't done that yet. So the intent is there for the SEC to put an enforcement action here on Coinbase, but it hasn't been done yet. So they're like, basically, you've been investigated. We're finding some stuff. We're letting you know that an enforcement action is likely coming. Now, it doesn't mean it has to come, but it's likely coming. That's what the Wells notice is. So again, when you see a Wells notice, they hit first. The algorithmic trading dominates this market. They hit first, ask questions later. Stock down significantly, 16%. We don't know what the enforcement action is exactly going to be. They gave you a little area of it, but we haven't seen an actual enforcement action here yet. So now it's a huge unknown. Again, Coinbase, It's, off 16%. It was yesterday. It was $85. When you're investing in these kind of companies, you're taking on significant risk. The stock just lost 20 points in literally less than 24 hours.
Yeah,
Square, same story, is down 20%. It's bouncing off that level of support that we talked about here. But again, wow, it's just a huge move.
Okay, yeah, let's wrap things up here. Square, a little bit of a bounce. We've got to wait to hear something from the company. As volatile as we had everything yesterday, we've had a nice, a nice rally overnight. I think we got to hold mid range here. Love to see us take out that pre-market high. If we do, not much in there on the upside. Conversely, if we take out the pre-market low, which is right by the close, the Bulls got to make a stand at 39.66 and a quarter. Yesterday's low, or things kind of open up on the downside. So that's it for today, folks. Everyone be safe out there, and be back with you later on.
All right, we'll see what
TradeZero
happens.
segment here, Mitch?
No, not today. I'm gonna hold it off. Just
Okay.
we're a little late. It's already 9:01. We're gonna get you guys over to live trading. I'm gonna adjust that. But like always, I will mention, of course, you guys can check out TradeZero if you're looking for short locates, right? Especially on a day like today that we could see some downside action in the market. You guys can check out, of course, TradeZero. I'll throw the link up in the chat so you guys can get access to the pro software, right? 3 months. If you guys go through that link, check it out, team. We're going to start wrapping up here. Going to take a look. I didn't get a chance really to talk about it, but I'm short on Chevron because I'm back to the oil downside trade. What do you think about
Chevron.
that? I got it yesterday, Dennis.
I like the 160 level. You're
159.17.
What price? Sorry, Mitch.
I'm at 159.17.
That's good price.
And I'm looking at that 160, Dennis, that you just mentioned. I'm trying to risk $1 above this.
Pure
but now that I took some
trade
profits,
here. Pure technical trade here. It looks like for Mitch. I kind of like it. Just wow, we're starting to get hammered on some stocks here. I kind of like that 160, the key reversal off of it too, Mitch. I like it too. Just because 160 was your support back in February, and we always say old support can become new resistance. So I like your technical setup.
Yeah, we'll see what happens. I'm looking for the gap to fill, really. If it can even fill right out the gates, I don't mind taking the money and run. We'll see what happens. There's a little gap down there. We'll see also if XLE continues down. That's really what I'm looking at more long, if it's going to be more of a sector-wide move.
Sure.
Last time we came to this trend line and we bounced right off of that. Do we come this time to breaking that 76 on XLE? Other than that, I'm sure we'll be watching big tech. Any of these you like a little bit better than others? Microsoft, Apple, Google. I mean, they're definitely making strong moves here. Any of these you like a little bit better, Dennis, or do you think you'll just all run?
I think they've run too far. I do like that they were pulling back. I'm long Amazon.
Okay. We didn't mention that one, but yeah, we could
Google. I've sold most of these here now just because I'm nervous about the overall market. It's not that I don't think tech can outperform. It's that I think the entire market is going to fall. If we're going to a banking crisis, I think everything is going to go down. So the sinking tide sinks all ships. I know that's a thing. Rising tide lifts all ships. Sinking tide sinks all ships. I just made it up. But it's not very good. Microsoft, I mean, I think if you get back to the 260 area in Microsoft, it gets interesting. Again, these things just aren't cheap, though. That's where I come back to, is they're not cheap. So as much as I think they're going to outperform here, maybe in the next little while, and that is what the market is doing, I just don't want to own stocks. I have the smallest long-term stock position that I have had in years. I've sold a lot of stuff. I'm sitting with like 55, 60% cash. The stuff I've had is some conservative stuff. The reason I'm getting I was tying money up at 5.1, 5.2%. It's hard to get that now because the rates are starting to come in a little bit in Ontario. But I'm like, why don't I take on this market risk and get 5%? Yeah, I'm not beating inflation with that. But I think we're in a really rough environment here right now with a lot of unknowns. So I'm getting paid 5% to wait. And that's where I'm sitting. Yes, I still own some stocks. I still got some Qs, so I still have some indirect exposure, obviously. Still have my SPY. Still have, a number of other individual stocks as well, which we've talked about on this show. But very conservative with my long-term investing here right now for the simple reason is that I think we got a lot of pain ahead.
We'll see what happens today. Like always, you guys can keep up with all the action. Keep up with Dennis Dick, Triple D Trader. We'll find out. And of course, it's going to be kind of clear to at least, we're going to be looking, the next CPI comes on April 12th. So we got some time for that. We'll see if we get some Fed talk out there. But like always, Dennis, you go do what you do best, my friend. Get to the trading action. We'll see what happens. All right, we'll take a look, of course, on Square in live trading. You guys can come over. That's going to start next. Let me make sure I got that redirect set. Yes, we are set for that. And we also got all access on that. So long show for you guys coming up next on live trading. I don't want you guys to miss it. And of course, we'll be working on some candlestick trading. You guys see me taking some setups all the time. You guys see me attacking the technical setups. If you guys want to learn a little bit more, come learn from Japanese candlestick trading. We're going to be getting into chapter 4 where we start learning reversal patterns. So if you guys want to learn a little bit more about some reversal patterns and you're into the technicals, check us out on the book club. We're going to keep pushing forward. I'm going to throw up that link, get you guys over now to live trading, and we'll find out what happens there in Square. Is that still an opportunity? We'll take a look underneath the hood. Here's the book club. Going to go ahead and wrap it up, team. Bring you guys over now to live trading. And like always, I want to go ahead and apologize for the Kathy joke. But like always, you know me, I'm going to start some little banter. I'll try my best to go ahead and quickly state that it's a joke, but didn't want to start a rumor there. Just get myself out of that rumor, but we'll see what happens, right? I mean, there's a lot of situations out there that draw questions, and sometimes I like to just bring the question. Right? I'm not necessarily giving the answer, but I just want to bring the question out there for investors to think about. We'll find out what happens today. You guys stay right here. Pre-market prep, like always. You guys can check me out on Start Swing Trading. That's where I take trades like that Chevron, right? You guys want to find out where I'm talking about those trades? We'll come to Start Swing Trading. That's from 3 to 4 p.m. Like always, we have great traders that join us, also telling us about their setups. We'll see you guys a little bit later on live trading. Let's see what we get into today. Hit the like button on your way out, team. I'll catch you next time.